Fuck is up? Hello. Oh, wait. I was gonna say, yeah, you can't unmute. I was gonna say your mic's muted. I realized you can't do anything about it.
What's up, brother?
Hey, not much. How are you?
Good, but fucking tired. I don't know what it is this week, man. It's dragging.
Dude, I get that. We all have those weeks. Don't blame yourself for it. Take it easy. That's what I always try to do.
I'm chilling. I ended green, so live to fight another day.
Dude, I cannot believe I ended today green, honestly.
I got stopped out of the two things that stopped me. It was I put it in the chat. It was like a hard stop, estimating on a level versus like just playing to this trend, and it fucking waked me right to the trend and broke upside cues. I was like, motherfucker. But yeah, it's all
Okay.
good, man. It's really frustrating when your plan works out. It like stops you by like $2.
Dude, all I was trading was Carvana.
Damn, you weren't kidding. You were on that shit.
Dude, I was not kidding, bro. I was not kidding. So I filled it. I bought yesterday or 2 days ago here, and then
Uh-huh.
obviously you know me, I didn't fucking sell them all. So I sold a good chunk, I don't know, somewhere yesterday, and then re-added. I re-added here, I think, and then didn't sell, or maybe I did, I don't remember, and then bought more here, and then oh wait, that's the wrong day. No, I didn't do shit on this day, I don't think. Maybe I bought some more. I bought some more like here. And then today I was going pretty insane. I bought more here, here,
Jesus.
and here, and then I was trimming them up here. And then finally I got all out of them on that pump. Dude, honestly, I'm not gonna lie, it was it was not bad trading. Like if I'm gonna recap it later, not in the lecture, but just for my own good and figure out where exactly I was entering and exiting. But honestly, the
Right?
entries and exits in hindsight were actually pretty good, but it was just fucked up
Nice.
because I'm just trading that shit into FOMC. It's pretty retarded, but it
Dude,
worked out this
honestly,
time.
if it works, it works. Like people are like getting chopped around and beat up on tech today, and like a couple of members, like all this week, dude, they're taking financial sectors, like fucking banks. Like who cares, man? If a setup's there, who cares what sector it is or what name? Like play it, you know?
Dude, I feel the same way, but River just totally does not like when I trade the shit stocks. Because he saw, I mean, long time ago when not that long ago, like 8 months ago at this point, where I lost a sick amount of money on this Roblox trade right here. I got long on the break of this trend and fucking held
Oh
them,
my God.
held them and averaged like here.
Kept buying the
And then
knife.
yes. And I lost like I think it was like I sent River all the orders today. It ended up and dude, it was so degenerate. It was terrible. So I he doesn't have much faith in my capabilities for trading them shit stocks. But dude, I mean, the what I explained to him and the reason that I've been on him is, dude, I just feel like the setups on him have just been more actionable for me. Like
Mhm.
like I don't feel like I could do much with Google when it's looking like this. Like it's so extended from the nine. Like I don't, and being more of like a swing focused trader, it's hard for me to want to enter a swing, when the chart's looking like this. Like I got it in Google down here, but I sold it all, on the next day. So it's not going to do
That's
me any
that's
good.
what I've been doing for like swings. I mean, that little small port tab that we got going, like,
Yeah, you're
dude,
killing it in there.
dude, Delta Airlines and CCL, like, they're fucking $42 contract into 66, $84. Like, that's, dude, I mean, I don't give a shit what it is. Like, if it makes me money, man, like, crazy.
Dude, honestly, dude, T was on a sick one today. Dude, look at this. I sent this chart in small ports yesterday. I didn't think it was going to break out though, dude. And it's ripped. Look at this,
Yeah,
bro.
dude.
What is it? Like 11 or 12 green days in a row ever since this red day. And this was like a lead cables day too. So pretty insane sometimes.
Yeah, dude, I got that dip when I got shares when River learned that last year, and I think I sold it. I'm on my phone. I can't tell if that chart's at 16 or 8, whatever the 200 MA was. Did
Oh,
we hit that? I don't remember, but I sold it a while ago. But yeah, right there, the 200 daily.
oh,
So
down here.
whatever. I left some meat on the bones for sure, but I literally got that almost bottom ticked it, like a dollar cost into it, and it's fucking sick.
Dude, the last time I traded T well was here, buying here at this monthly level, and I didn't buy again here because I saw we broke it, but should have just got shares or something, but I didn't. So I'm
Yeah.
retarded. What's up, Tilio?
So, fellas,
How you doing, man?
we're fucking doing
Yeah? Are you bricked up after Powell or what, man?
ripped up.
Yeah, bricked up, man. Like, are you wrecked?
Yeah, I mean, it was really a non-event in my eyes.
Dude, a lot of names didn't love it. Rate sensitive names were
Well,
not
I,
happy.
I, I shouldn't say non-event,
I
interesting,
was gonna
but
say
not non-event in terms of,
the results.
yeah, I mean, nothing
Right.
new really. If anything, I would say there was more. You strip out what we already knew, which was, no March hike or cut. I would say leaned a little bit more dovish.
You think so?
Yeah,
I
in
didn't
terms of
read
the way
the.
in terms of the way he was talking, before talking about, that like their goal into the end of 2023 was unemployment at 4.1%. Now they're pretty confident that the economy or the labor market doesn't have to take a hit. And of course, he keeps on saying they got to wait for more inflation data, but um, pretty confident that it's going to continue in the right direction without any external unknown disruptions.
Dude, the one thing was weren't yields. Yeah, yields were down today, which I found odd.
Yeah, yields moved lower, and maybe that's the bond market calling bluff. Obviously, I'm the way I look at it. Obviously, and I said this a few meetings ago. The Fed isn't going to tell you when they're going to cut before they probably right about to cut. I don't think it'll be ran right up into the meeting that they do cut. Maybe it will, but they're not going to come out and say it because of the euphoria, and especially with the stock market at all time highs, everything's doing well, the economy's great. Of course, they don't need to cut right now, unless inflation seriously falls off of a cliff, which wouldn't happen, or the labor market really starts to take a hit. And of course, we'll get a read on that this Friday with the jobs data. But um, to me, it's just going to be smoke and mirrors for the next few meetings. We should already know what they're going to say based on the data that we're getting. So to me, as far as their transparency that they've been talking about each meeting, and before the blackout period too, when all the Fed officials were talking, I don't think that transparency correlates into kind of posturing and what they're going to do. Like I said, they're going to sound more hawkish because they can at this point. They truly can, but that doesn't mean that they are hawkish. You know what I mean? So
Sure. Dude, I find it interesting, and this might be a little unrelated, but I find it interesting to see all the layoffs that have been coming. It reminds me of like June 2022, personally.
but
It's
yeah, they've been nonstop, and that's why we'll see with Friday's data. If we get a soft number, uh, let's say that because the two mandates out of the Fed is essentially maximum employment and price stability. I mean, those are the powers that Congress gave them. So if you do start seeing that in unemployment rate ticking higher, because there have been a lot of layoffs, and inflation stays the same, then they would definitely be able to cut at that point. Inflation's essentially down to their target goal, especially if you look on the past 3 months kind of predictive deflator gauge. It's at 1.9%. So if we get a soft jobs number this Friday, I don't know when our next CPI release is or the adjusted CPI, but if the economy or at least the labor market starts to soften a little bit, then I think they can go ahead and cut there.
dude, you just know too much.
And you're probably gonna have to repeat all of that once everybody joins.
Oh, he will. He will. Somebody said they had trouble with the link. Just so you know, I did post the link, so no more saying anything incriminating. Don't worry, Cecilio. Tilio will he'll get going. He'll get real active for you. So don't you worry about that one.
I thought we were already live.
You did? No, we were just talking. We didn't have anybody in here yet. I just wanted to hear your thoughts.
I don't think I can repeat all that.
We better break 100 tonight. We better break 100.
Dude, we better do better than that. What's going on, everybody? We're gonna get going in a couple minutes. Just gonna give everybody the chance to hop on in. Oh, we already got the memes going. It's that time of day, man. What's going on, everybody? We're gonna have a real good crowd tonight. We got Al Brooks in here too, so that's how you know it's gonna be a sick one. Attorney Dan. Does anybody else having issues with the Zoom link? Attorney Dan is saying he's having some trouble. Let's see. I mean, it seems like you guys all did just fine. This will get uploaded to the YouTube later. That is correct. Just slow. I can't help if it's slow. It should be fine. Should be fine. All right. Dude, what is that? Well, how's everybody's day been? You guys make some money today?
Hey, Talia.
What's going on, River?
Dude, another day. How you doing?
Oh, we're doing.
Oh, we're doing.
FaZe is here.
Oh, dude, I love face.
MCI to 600. Just gonna give it a couple more minutes, everyone. We got quite the crowd in here tonight, so it should be a fun one. Should be a fun one. We'll see though. Still waiting on Flips and Shark. I'm sure they'll arrive at some point, or maybe not. FaZe, you got your camera on, bro. How come FaZe got his camera on?
FaZe, what are those 45-foot ceilings?
FaZe, keep that on. Yeah. Dude, I didn't know you lived in a mansion.
Damn, face is rich.
Dude, I did not know he had it like that. We can't hear you, bro.
It's even better that we just see him talking.
Well, it's probably on another call. Dude, I like this. We gotta get FaZe in here with camera on in every lecture. Yeah, FaZe is rich. You don't get a house like FaZe with no facial hair, that's for sure. Dude, the chat's loving FaZe.
Just thankfully he's fully clothed.
Yeah, you're lucky he had his tarp on, or else we would have had a situation. We can't get another HR violation. We already got too many.
FaZe, you probably get your 1,000 steps in going up and down them stairs.
He's probably got a butler that carries him up. Dude.
He's got an elevator for sure.
All right, one more minute. I'm gonna send out one more message.
Oh, come on, Toasty.
Nando was in here a little bit ago, but I don't know where he's at now. I'm just gonna say he's in here though. All right.
I mean, is there really anything left to say that FaZe didn't just say?
You're right. He did cover most of it. He did cover it. All right, a couple minutes after the hour, so I think it's safe to say we can go ahead and get right into it. So, welcome everybody. Welcome to the podcast lecture for the month. Some of you may have been to one of these style lectures of ours before. Some of you may have not. So, just to give a brief introduction to the format, tonight we're going to be joined by a good group of our analyst team here at Only Options Trades. So, we're going to kind of switch around talking. It's going to be more of a podcast style format. I'm not going to have a PowerPoint on screen or anything like that. We'll be talking through charts, talking through data, all that good stuff, answering your questions. We do these types of lectures once a month with as many people as we can get in here. So if you guys like this format, make sure to let us know and we'll do it again, maybe more frequently if you really like it. That said, tonight, the topic is going to be talking about everything that we learned after this current FOMC meeting that we just got through today and a general outlook on the market. That said, we're trading at all-time highs, got a lot to talk about, a lot of different sectors moving in different directions, a couple of new pieces of data to be mindful of into the end of the week. So going to work on covering as many different topics related to that as we can and answering your questions while we do all of that. That said, again, as I mentioned, we're joined by a big group of people, so it might be useful for us all to introduce ourselves. So maybe you're familiar with whose voice is who, because probably not used to all of us being in the same place at one time. So we'll start it off by letting you know who everybody is. So yeah, I guess I'll kick it off. Some of you may have been to some of my lectures before. My name's Toasty. Yeah, who's next? Tilio, you're up. Introduce yourself.
Yeah, I'm Tilio.
1K.
Hey, I'm 1K. I'm cooking a steak.
And FaZe, does he talk? FaZe was the guy with the camera on. Yeah, we can't hear him. You got to turn the camera on, FaZe. We can't hear you without the camera. All right, perfect. All right, there's FaZe and River.
Hello.
All right, we got a real outgoing group here tonight. So let's kick it off talking a little bit about some of the data we got out of the Feds today. And I don't have a great graphic to kind of recap that at this point. I guess I could pull this tool up. But generally speaking, a couple interesting things to be mindful of. Generally speaking, those of you who are or are not familiar with the event that occurred today, it was the FOMC meeting. The minutes were released today, and we also had Jerome Powell provide a speech on some of his thoughts on the current state of the economy, as well as the Federal Reserve Open Market Committee's plans for the future. And big decisions out of the day were essentially rates remained unchanged. The probability of rates being lowered throughout the rest of the year remains open to interpretation. Generally speaking, Powell left the door open for potential rate cuts throughout the year of 2024, but no specific timeline on when those might occur. And we're going to get into a little bit more detail on some specific outcomes. And I feel like Tilio is probably the best to start talking about. No, FaZe, we can't hear you. Tilio is probably the best to start talking about some specific thoughts and kind of his conclusions coming out of this first meeting of the year. So Tilio, I don't know, would you like to take it away?
Yeah, and I'll just say everything I got to say since I got to head out of here. But yeah, nothing new really this meeting. I would say the biggest thing new, and I'm just going through some of my notes here from the press conference. Obviously, you had Powell like normal, 5 minutes, a little introduction. Everything we've been hearing, inflation still too high. Progress bringing it down is not assured. Uncertainty. Recent economic activity expanding at a solid pace. So that was a change, and they even took that out of the initial release too, as far as economic activity slowing. So they acknowledge and probably after the latest GDP read, how strong the economy is right now. They brought up another inflationary concern, which was nominal wage growth easing. And that was something I've highlighted before out of some of these employment reports that we get like this Friday. As far as the job market can be strong, but obviously if wages are constantly going up, that could be a concern there to spark not a new wave of inflation, but obviously hurting the Fed's goal here of getting it down to 2%. Another part from that intro, we believe policy rate is likely at its peak for this cycle and some point this year appropriate to dial back. So that was a big change. Yeah, and I forget the specifics of what they talked about last meeting, but it's guaranteed unless there's some external force that supply shocks again, or geopolitical tensions, kind of like Ukraine and all that, that can spike up inflation. The Fed's definitely done with the hiking. So kind of like you said, we're at the peak for this cycle. Prepare to maintain current funds rate for longer if appropriate. So it's really been the same old. As far as the Q&A here, some of the things here that I noted. All right, so Powell kept talking about as far as confidence in inflation. He kept bringing up that 6 months of data isn't enough data, and he kind of danced around the idea of what they mean by having confidence. So I would say they probably need 3 more months of good data to know that it actually is in a downward trajectory, even though we already know that it is. So the market moved a little bit higher there. When he also said he's looking for inflation to continue to come down and not the economy contract. So before they were talking about unemployment getting up to 4.1% by the end of 2023. So they were essentially, in the remarks, they were looking for the economy to kind of slow down quite a bit to reach their target goal of 2%. And now they're finally open to the idea that the economy doesn't have to take a hit, labor market doesn't have to take a hit. So that's a positive. The market moved a little bit on that one to the upside. Someone else asked, was there a good reason there to keep policy above 5%? And he kind of just said the same thing from the first question, as far as their uncertainty, that it is going to come down to their 2% goal. So more data for the most part. Let's see. Not declaring victory at this point, ways to go. Market moved a little bit lower off of that. But some of this commentary, I was saying earlier before everyone joined, you're going to hear this out of the Fed until they know they're about to cut. So that could be the meeting before the first cut, or that could be the meeting of the first cut, because they have all the kind of firepower right now in their pockets. A couple basis points of cuts that they can dispose of at any time if they need to. There's no point in doing it right now. So, if they get overly dovish right now, market's already at all-time highs. That creates wealth in and of itself, which could obviously increase prices, purchasing power. But the big thing from the Q&A, and this is when we set those new day lows and continued lower, and I would say this shouldn't be a surprise to anyone, but he finally came out and said that no March rate cut is on the table at all. It hasn't been talked about. So that's where we eventually sold off. So that was just, if you want those notes, you can just send me a DM. I can send them. But basically, same old, same old. The big thing out of this is we finally got that 100% viewpoint from them that they're not going to cut in March. But as I was saying earlier, depending on how the data goes, and I would say more on the employment side of things, going into that March rating, if inflation stays where it is or slowly trickles lower like it has been, that's probably where, and I don't know the chances of that happening. There have been a lot of layoffs recently, costs cutting back a lot out of these big companies. So if we do Friday, for example, see a soft employment report, the next employment report soft, maybe they will consider at that point then, a 25 basis point cut. But right now, everything looks too strong. So it wouldn't make sense for them to make any adjustments right now. So that was basically the press conference today. Friday, we'll get that next, I don't want to say big move, but we'll get some volatility in the pre-market session there off that employment report. So I would say if you're bullish on the economy and you want to see good data, obviously you want to see strong numbers again. If you're looking for a reason to why the Fed can potentially cut sooner than later, then you're looking for a soft number, and average hourly earnings too. We'll get that data. Maybe you want that to come in quite a bit lower. I don't know what the last month's read was, 4.1%, I think, year over year. increase in wages. So you're kind of, it's a balancing act right now in my eyes. What the market interprets as good data, good economic data. That means that the Fed can stay longer or higher for longer, slowly get more bad economic data. And then if you're bullish on the Fed cutting, bullish on the markets because of those cuts. So it's kind of that seesaw right now. But that's basically all I had as far as the notes from the Fed. And yeah, obviously we sold off quite a bit today, but I would say definitely don't get too caught up in your emotions. We saw those whipsaw effects a lot recently on these catalysts. But as far as right now, and what I've been telling people is, for me at least, to get kind of negative in the short term on the markets, 4,800 SPX is that level that I'm looking at. And that was the previous all-time highs, give or take. But it's also on the weekly chart. I like looking at the 5 and the 13 EMA. And since we kind of trended higher in October, I think it was, of 2023, we've been respecting that weekly 5 EMA. So that's where I'll look for a trend change there, to maybe look short term into March or so to get negative on the market. And rather than buying the dips or looking to buy the dips, I'd be more interested in looking to sell the rips. So 4,800 SPX. But as of now, like I said, it's, don't go in there and just put all your money on these dips. But I would be more cautious getting short until we break that 4,800 level on SPX, especially when you're getting some decent earnings out of some of these bigger companies here. And even though their stocks aren't reacting too positively to it, it's been quite a move going into these reports. So, and we'll get more from Meta and Apple on Thursday. But that's kind of where I'm at right now, is cautiously bullish until we see that trend reversal.
Julio, obviously, you always offer some of the most detailed insight I think anybody could probably ask for. I think one important thing to cover, and I don't know who best would be to cover this right now, is what is the significance of the FOMC, and why do things like this and other economic data matter? I think it's something that people really don't realize, that there's real world, I guess I'll call it, data points or events that matter in markets. I think it's easy to forget it when you're so focused and ingrained in charts. So it doesn't have to be you, but maybe River, I saw him on mute. Why would you say the FOMC matters, or what is the significance in a couple sentences?
Well, normally they don't matter. You wouldn't even think twice about trying to not trade around the data or the Fed events. Well, you just wouldn't be interested in them. But now it does, obviously, because of this kind of crusade that they went on with the rate hiking cycle. And you've seen the companies that have just been slaughtered. A couple banks have failed. I mean, just the cost of service, a lot of that debt, especially in those small caps that have a lot of debt. So that's why it matters right now is, and historically, we're not even in real restrictive territory. But so right now, I would say it's more of, maybe they're important because it could be a sigh of relief, as far as this restrictive territory. So if you're a market participant, yeah, it's, I would say once we, in 2-3 years, come back to, call it the pre-COVID kind of area where, policy's not tight, it's not loose. We're not at 5% federal funds rate, we're not at 0%, kind of like the two COVID extremes there. Then they're not going to be that big of an effect. But yeah, right now and especially when you got a market that is pricing in a lot of rate cuts. I think, I don't even know what it was going into this report, but 7 to 9, I want to say, market was pricing in rate cuts into the end of this year. The Fed officials, I think at their last dot plot had 3 to 4, I want to say. So there's kind of that divergence there. And that's where the market just, or the Fed, I mean, the market could be calling the bluffs. And maybe you saw that today as far as the yields closing lower with equities. But you're eventually going to kind of meet up there. But normally, yeah, these data points and Fed events, they're really not that critical. I mean, like I said, you wouldn't even think twice trading into those.
Good point. I guess maybe a good chunk of it, my judgment is clouded, considering most of the time I've been most heavily involved in markets. The big significant event is the FOMC. Coming out of COVID, and ever since, it's really been quite the important thing.
If you pull up that the fund rate chart again and zoom out a little bit, you can see when people cared about what the FOMC was doing historically. You know, obviously you can see it around that 2008 time. None of us were trading at that time, at least heavily, you know. I was just getting clobbered on shares. But people cared what the FOMC was doing around that time. Then you can see during the 2018 financial stuff when, you know, Trump and Powell were button heads, people cared about the FOMC there. However, when you have a Fed fund rate sitting at 0 for 8 years or 7 years, you know, nobody cares what they're doing, you know, because that their whole, you know, the Fed's entire focus is interest rates regarding monetary policy in America. I mean, in simplest terms, that's all they care about. And so when their interest rates are 0, they're basically just kind of sitting there being the bank. You know, that's it. They aren't doing anything. However, when you come into, you know, extreme inflation, like you can see back in Volcker times, like obviously you couldn't trade like we do today. But if you go back to that late 70s, early 80s, I'm sure that when that dude started talking, the markets were insanity. Granted, you know, they traded at a much lower price, but when you got Volcker hopping on and doing a 500 BPS cut in one meeting, the markets absolutely go insane, you know.
So Tilio and River, I want to play a little bit of devil's advocate here. If you take a look at this chart, right? You know, I agree that pre-COVID, especially from 2008 to 2017 or so, we probably didn't see much interest in any kind of Fed meeting. With that said, given the fact that we've seen such a significant volatile economic landscape, so to speak, with our interest rates spiking, inflation spiking, now coming back down, you can see that during the Volcker era, we saw quite a bit of volatility with every Fed meeting, going back from 80s all the way up until mid 90s based on this chart. And frankly speaking, this is the first time I'm seeing this. I know from the banking sector, I don't care during 2008 to 2015 or prior, the Fed meeting has always had some level of significance. But with all of that said, do you really think that going into the future, 5, 10, 15 years from now, we won't see that Fed? I don't anticipate seeing that federal fund rate go down to 0 again, right? With that said, do we really see that over time we're going to see some sort of stability to an extent where none of this will really matter as a trader?
I think so. Yeah,
I would think so for sure. I mean,
it's to me at those extremes when you got maybe it's unemployment piling higher, inflation, you know, the sporadic moves in inflation or some geopolitical factors that affect supply chains. And I mean, that's even right now what the market is or what the market should be caring about, the data points we get and all that. And then you can kind of judge what the Fed is going to do or should do. But if it's just kind of cruising along, the economy, everything's good. We're not in a free money era again, but we're not in extreme restrictive as far as the recent times go. I think they're no big deal. It's you might see some volatility intraday in the market, sure, but nothing like what we're seeing right now.
No. And that's even, I mean, on that Fed funds rate, you're right, FaZe, that, you know, they were elevated. So they did have an effect. However, the market traded completely different. I mean, the futures market in the 70s and 80s was not like, well, SPY didn't exist as one example, you know, I mean, that's just one thing to think about. But when you look at this, like from 85 to 90, there was a little bit of moving around, but it was, you know, staying in a 1% range. And then you see it again, 95 to 2000, a lot of like sideways movement on it. So I think that the important times are when you're seeing those dramatic ups and seeing those dramatic downs. However, if you're, I mean, and don't get me wrong, you know, that time in the 90s, like you were talking 5 to 7% rates consistently, you know, there was obviously some volatility around it, but it's when you're seeing the big spikes and the big drops that you're going to get those dramatic effects on the market. I mean, you can look at what Volcker did, take it from 5 to 17.5, then in 2 meetings, drop it to 10, and then run it back to 18. That was mayhem in the market. And it caused a truly horrible recession, you know? And so, you know, that's a crazy thing to think about. Like, I mean, I guess I'm a little older, but, you know, if people's parents are buying houses in the 80s, a 15, 17, 18% mortgage rate, not even remotely uncommon, you know? And so I think it's just really important to pay attention to those volatile times, which we're having right now, like Tilia said. But going forward, even if we only, like, I hope we don't go back to ZIRP. Like ZIRP, you know, the zero interest rate policy was a huge factor in what is occurring now, you know? And so I sure hope we don't go back there, but get it back to that 2.5%, which is just like, you know, I mean, God, you're going to borrow billions of dollars. You can pay 2% on it. You know, that seems reasonable to me, but I don't know for sure.
I think one thing to mention about what you said there, River, is kind of drawing back what this rate means in kind of the real world, I'll say. Because obviously a lot of what we've discussed, you know, we've talked about how what the Federal Reserve does impacts financial markets and the economy as a whole, but it might be hard for some people viewing to kind of understand the significance of this rate. So I wanted to just take a quick second to explain. Essentially, this Federal Reserve funds rate that we're looking at here is really the price of money in the United States at its most surface level. If you look up far enough up the chain, eventually all money is going to be lended from the Federal Reserve in some way, unless, you know, at some point everybody's getting a loan from the Federal Reserve through a couple different intermediary people, whether it's a bank or JP Morgan or BlackRock or whatever. Eventually the money's coming from the Fed. So the Federal Reserve's target funds rate essentially sets the target rate or a baseline rate for larger term loans or any term of debt, any kind of debt in financial markets or the economy as a whole. So for example, that's why you've seen, you know, so many people have probably noticed in the news that mortgage rates recently were getting close to that 8% mark and hovered around there for a couple weeks before they backed off down below 7, I believe is where they're currently resting at. And that's just, you know, one factor that's ultimately determined by what the Federal Reserve is doing. Because when that Federal Reserve funds rate changes, you see those changes reflected in bond markets, which ultimately get reflected in, you know, real debt that people are taking on. So wanted to kind of draw that connection there and make sure you guys are aware that even if you could care less about what this means for the market, it's absolutely something to be mindful of when taking out, you know, even your own personal debts, whether that's a car loan, personal loan, mortgage, etc. So just wanted to draw that connection.
Yeah. And I did want to say one more thing. You know, we are talking about how these things will, like, you know, they won't matter, you know, when it levels out. Right now, they matter. They 100% matter. And everybody should pay attention to where they are, because it will, until we get to, you know, a nice leveled out area at a reasonable rate, it will likely continue to have a dramatic effect on the market.
And I think it's important to highlight the Fed's whole goal when modifying or modulating this target rate. Some of you may or may not be familiar. The whole kind of goal or campaign of the Federal Reserve at this point in time is to control inflation. That's really their number one priority. And this is really the main tool that they have, is essentially changing the price of money by changing their Fed funds rate. So essentially when they raise their Fed funds rate, money becomes harder to get. So ideally that replaces or lowers inflation by making it harder to get money. So demand drops and eventually that affects labor markets, et cetera, et cetera. You know, there's some significant correlations that go on. You know, I'm no economist and I don't claim to be one, but another thing to keep in mind there. Anything else on the Fed, guys? Anything else notable from the meeting today? Things to be mindful of in the coming weeks or for the next meeting before we move on to the next topic?
I would just say, you know, even though earlier I said that 4,800 level SPX, you know, that's where I'll get short-term more negative positioning rather than buy the dips, look to sell the rips. You're probably going to, you're going to have to see some sort of repricing on risk equities now that the March cut is essentially off the table. But like I said, of course, Friday's job number could maybe give you some short-term fuel to go higher if it comes in soft. But I do think that, you know, and we've been seeing it too. I mean, look at healthcare hitting a 52-week high today. So there's some rotation going back into defensive names. And you're seeing some of those. And of course, some of it, they made big runs, you know, your tech names and whatnot. But I would just watch some of those more kind of yield sensitive areas to see how they fare these next couple of days / weeks. And then just keep watching your kind of more defensive sectors. Because that might tell you a little, at least for the next, you know, maybe the rest of this quarter going into the second quarter. So because we can certainly break that old all-time high on SPX there and retract a little bit further. So that's what I would say, especially tomorrow. Just look for some of those. We're going to have to reprice that March cut. So short term, that could be some pain for these risk assets.
Can I got a couple questions for you, Tilia. I always like to see if we're thinking the same or different. Big sell today, definitely no denying it. But then when I think about the things that Powell said today, I mean, there was some real positives in there. I mean, one of the major standouts to me was that, they said there no more hikes. And to me, that's a really big deal. Yeah, exactly. We believe policy is at its peak for this cycle. That's huge, because I mean, there was no reason to think that they were necessarily going to do another hike, but there was a chance. And that is the first time the Fed has taken the step to say, hey, no more of these. And then on the second half of that, the Fed has been so direct, and they have stuck to virtually every single thing they've said. They've done, and everybody knows, I think Powell's done an amazing job, and they've stuck to everything they've said. And they did say, no cut, obviously, and they aren't, considering a cut. They've continued to say that over and over and over again. I mean, I make the joke that the only people saying they're going to cut is CME and Twitter, but it's kind of true. The Fed has never said it. So I guess my question is your opinion on the sell today. Is it an overreaction? Because I took most of what Powell said as overall really good and positive and upbeat. I know he did talk about some of the sticky, sectors of inflation being around, but we know those are there. And so, I mean, I know that there was a couple things that they were obviously going to sell on his statements, but I know that I was personally surprised to see, a $6-7 sell on SPY on what I took as a relatively good, good speech and upbeat outlook. And so was it just the fact that the market thought we were going to get six cuts and we aren't going to get 6 cuts? Is that what the sell was, or what's your opinion?
Me, I think it depends on what side of the field you were on. If you were on the side that, peak rates are in, at least for this cycle, they're not going to hike anymore. But they're definitely, there's no reason right now. The economy's too strong for them to start cutting rates. I mean, that could put everything they've been working towards at risk on inflation. Exactly. So I think if you were on that side where peak rates are in, they're not going to hike anymore, but we weren't expecting a March cut anyways, then I think this speech today, at least for me, was a positive, because he did, from the last meeting, to me, they're starting to flip a little bit more dovish. Like I said, they noted the strength of the economy right now and the progress there as far as their dual mandate. Unemployment hasn't been rising, inflation's been coming down, and so that's a rarity. So on that side of it, it was a positive. If you were expecting the March cut, then yeah, of course you're going to have some repricing there. If you were offside, basically what Powell did on that side is, if you're looking at that March cut, the predictions there, I don't know what it was going into today, 55% or something like that, but it was as high as 90%. So if you were looking for a cut in March, then yeah, you were probably caught off guard a little bit for whatever reason. And Powell basically just came out and said that, they can't keep the market can't take what he says anymore for granted. So that's why it might sound a little bit more hawkish to them. But like I said, if you were on the side that, we know they're not going to cut in March, but they're flipping dovish ever since the last meeting, they're not going to hike anymore, then I would say it was a overall positive. But you look at the market, and I mean, we haven't stopped at all since we put in those lows October of 2023. We pushed a new all-time high. We kept running, pushed up to that 40. I don't even know what we did. SPX.
I mean, yeah, new all-time high every day for 5 days or whatever. Yeah.
Yeah. So you gotta have those breathers. I mean, it's things can't just keep going up and up and up, because that's when, and that's the risk of this year, is pricing in all those forward gains. And basically the last month of 2023, first month of 2024 is we potentially priced in a lot. So there's going to be some of that repricing. And so that's why I would say just, look at some of those riskier interest rate sensitive names for the next couple of days, couple of weeks. And that would probably paint a better picture going into March and April. But overall, I think at least I don't know where we started this year. I don't think we broke all-time highs yet, but I think we close positive just on the fact that if the economy does still hold up like it has, inflation does come down. I mean, that's strength right there. And then you got this whole rush now of AI capex. All these companies, and we've been hearing it out of these reports, the amount that they're investing, tens of billions into this new AI kind of craze there. I mean, that's going to be a big market. So there's a lot of money that's going to be going into notable companies right now, less notable companies. So there's going to be a lot of spending taking place, which is obviously good.
And that was, I guess I should have clarified. I obviously didn't expect us to just go on this moon mission or nothing like that. And obviously market could use a little bit of a pullback. But it was just hard. It was just hard for my brain of I think I'm kind of thinking on the same thing as you of what is good news and what is bad news? Because, for so long, bad news was good news. And I think we are just kind of in that middle ground shift now where, good news can be good or bad. And the market isn't quite sure. Because I mean, I was just surprised on the sell of if you listen to what the Fed said, there was no cut coming. And so I guess I just didn't expect. I mean, we ended up having a big volume day in the market today. And I kind of had thought about it like you with, people being caught off guard. I just didn't expect that many people to be caught off guard.
No, and I think you're just seeing that simple shift, really. I mean,
Yeah.
A lot of these, especially the Mag 7 names, they got extremely expensive. They were going into some big numbers that they had to put up, and they did put up good numbers for the most part, but they weren't phenomenal numbers. And we already saw that out of the financials and the move that was made there. They sold down on it, quickly rebounded. I'm not saying that'll happen to Microsoft and Google. I think that it should happen to them. I don't know about Microsoft. That's obviously still pricey, but right now they're dominating the AI space if you're looking at their competition, such as Google. But I took the meeting as overall more dovish than the last meeting. As far as the stuff that he said and that they came to basically agree on with the economy, now they're not looking for unemployment to skyrocket. They don't want to see that. Before they did want to see that. So if everything holds up still and inflation continues its move lower, I mean, you got to be pretty damn bullish on the U.S. economy and therefore U.S. companies. So and hopefully nothing comes out of it as far as any surprises, but we've been dealing pretty good with everything that's been happening overseas. There hasn't been really any shocks there. And those could also be tailwinds, which is another positive. But yeah, I think we ran quite a bit, expecting a lot going into that March meeting. And yeah, maybe some people were caught off guard there, but at the same time, I think some people too right now, they want to buy some names that are trading at a discount, and that kind of started almost after GM reported, and they raised their guide. I forget what it was, 10 billion, maybe. I'm probably wrong on that, but they were trading it like a 5 price to earnings, and they're guiding for whatever that percentage difference is. So they're basically if you want to look at it at that scale, they're trading at a 50% discount. So you might see that too, some of these high flying tech names, which right now I can really only think of Microsoft. I mean, Meta, realistically still speaking, is probably the first or the second cheapest out of the Mag 7 names. Then I would say there's Google and then Amazon. But you might start to see that rotation, which that's another positive to me. That's the market broadening out there, which you need to see for a sustained rally. You can't have it on the backs of the Mag 7 anymore.
Yeah. And I mean, there are just so many names that are still just beat up in the market that really should be seeing some buying by now. But this, I mean, I've been, the rate cut trade is those small caps. And man, they just they just can't hold it quite yet, I mean, we hit some IWM today for a nice little bit of a ripper, and then it ended up being one of the more clobbered ones there was. I mean, it went from big green to nice and red. It was the only one that didn't get smoked, and then it got smoked. And so still just that small cap trade waiting to catch up, I think.
Yeah, and that might sadly be, more of a waiting game. And that might be the one sector there that you really need to wait until we actually get our first cut, because that first cut could mean, the more cuts.
Yeah.
Maybe not just a one-off cut. And that's where you'll see some of those companies that, will thrive in a lower interest rate environment. I don't want to say thrive, but obviously they can't do too good in these restrictive territories. So,
Yeah.
yeah,
And
I would.
we got that big move out of them off those October lows, and that was, I mean, that is kind of what I was thinking, that was, people getting excited based on some of those rate cut predictions. And then that ended up, well, I mean, don't get me wrong, they're still up real nice. The IWM still up great, but kind of seeing that, we might have jumped the gun on the all small caps.
Yeah, and they might not even see that 161 level again, because we're finally, and that low was put in too, where we officially got the Fed pivot, the soft pivot, I'll call it. Finally changed their stance there a little bit. But yeah, in the near term, that might be I think my last buy was at 188 on there. Just the stock, not any options or anything.
Yeah.
That's to maybe pick some more up again, but I think that'll be a longer to play out. But you also have that divergence where IWM is still, more than 20% off of its highs. Meanwhile, QQQ broke out, SPX broke out. So I get with that statistic I showed in the last newsletter, 2 newsletters ago, where that rarely happens for any rally to sustain, not having small caps participate. So you just need to see that broadening out more. But
well, that was just another one of the things, because we had the Dow on a rip. The Dow has just done insane and was the first one setting new all-time highs and all of that. And so, I mean, I keep wondering when them small caps are going to get the bids and hold them. They just aren't quite doing it yet.
Hey, Tilly, it's 1K. I got a question for you.
Yep.
Can you hear me?
We got you.
Sometimes you just got to start asking, otherwise Tilly won't respond.
Oh, shit. So regarding the Mag 7, and you've mentioned it in newsletters in the past about you want to see like the other participants kind of, catching up and moving along with it. I'm not sure how to word it, but how do you use that in your trade plan at all, and kind of just see what everything else is doing to kind of see? I mean, obviously we want to check SPY and SPX, but like see where everything else has in the market to kind of make some moves.
I wouldn't say short term, no. But to feel confident, like you pull up SPX on, a weekly or a monthly chart. Now I will say the monthly that we closed above those all time highs was definitely a little bit more encouraging into the end of the year. But no, maybe on a bigger term picture, 3 to 6 months out to a year, to feel confident on any breakout to be sustained. Yeah, you can look at any kind of breadth gauge there. Like the one I like looking at is you can pull up the percent of stocks trading above their 20-day or their 50-day or their 200-day. And you want to see that breadth expand there and have more stocks trading above those SMAs. You can also look at the equal weighted SPY, which is RSP. That doesn't have any, it's all equal weighted. So you're not kind of leveraged there with your tech names. And you want to see the same thing there. That's still trading below its all-time high. So yeah, to feel confident, at least in 2024, you want to see some of these, I don't want to call them lagging sectors because they have made a nice move, but you want to see them participate more and catch some more bids. And we have been seeing that. I mean, breadth weekend a little bit on the rally 2 or 3 weeks ago, but last week was a lot more encouraging. I think we went from, like 40% of S&P companies trading above their 20-day to, I think, like 55 we closed out the week. So you just don't want to see that divergence where you got your SP moving up, but you have less stocks that are trading above their, like I said, 20-day, 50-day, 200-day, whatever it may be.
One thing that I find interesting, just from a breadth standpoint, is pulling this up now. It still looks like even today, new highs found a way to outpace new lows, at least on the NYSE. And we could see if a similar characteristic is shared on the NASDAQ. But pretty interesting to see that. Yeah. So still new highs outpacing new lows, even with all the new, or I guess, significant downside that we got today. So something to be mindful of. It seems like breadth is still reasonably strong, at least in terms of maybe not the biggest mega caps, but yeah, something to note there.
And right now, I mean, you have to strip out today. I mean, it was a Fed event. Like I said, maybe it caught some people off guard that were expecting more out of the Fed in terms of the rate cuts coming into March. But from here is what's going to be important the next couple of trading days, and kind of seeing how equities trade, especially some of those more interest rate sensitive names, because that can paint the picture. But as of now, the tape has been extremely strong. So that's why I'm more confident. But that could change tomorrow. That could change Friday or Monday. It all depends. But as of right now, rather than, especially going into closer day, rather than trying to stay short, to me, your window there is down to 4,800. I don't know what SPX closed at, but that's a small window. And when you get that oversold intraday, you're almost due for the risk of a bounce. It doesn't have to be a sustained bounce, but right now until the momentum shifts, it's more buy the dip than sell the rip. But like I said, that could change here in a day or a week.
Yeah, and that is something that I do just want to point out, because we got a lot of people in here, and I got, a bunch of DMs about this, of course, of like, oh, market's dying, this is the top, the end is near. And, this, like, people need to understand that this is not a technical breakdown. This had nothing to do with technical analysis. This wasn't like support gave up and we sold, this is completely news related movement in the market. And so it's always good to take one, a daily candle like we have today, which is hideous. If it was any other day, bearish candle like that closing on its lows, obviously you can swing short on something like that. But when the entire sell is based on the back of news, you want to really be cautious just becoming the mega bear after one red day based on news.
Phase one of this study that I have down below, so I figured I'd just send it out to everybody. That's what I'm doing.
But yeah, I would definitely, days like today, there ain't nothing wrong with sitting cash, especially if you're kind of just going with the whole trading mindset there. I mean, maybe there's some dips you can buy. Like I said, I bought some Google shares after that report just because I really didn't see it as justifiable to be selling down what it did. But yeah, days like today, it's easy to get caught up in your emotions. You see all this selling, and sure, maybe we could gap down tomorrow. You never know. But the risk reward just isn't there. So rather than taking any trade, if you're kind of tied up in the emotions, and that's why you want to go short, just because it was a big red day, just sit cash. You could wake up with puts that you swung, maybe you could wake up down 70% tomorrow. You never know.
I swung a call, Tilio. What do you think of that?
Hopefully it works out for you, and hopefully it works out for me too.
Yeah, I don't know. I just saw that sell off, and I don't know. I there's nothing I like more than the contrarian trade, and I just, everybody knows I'm a bull, obviously, but that meeting to me just sounded like what a great dip to buy, I felt like it was, to me, that was the place worth taking a stab, I feel way, way, way more comfortable swinging calls on, an $8 down day than I feel on swinging puts on an $8 down day, greed just always gets you in the market. And so you're telling me I can get a next week 490 for $100, I'm taking a stab.
I think one thing that you mentioned there is important, River, too, is that you're listening to the call and to make that decision. You're not just trading blindly because you feel like taking calls. You're listening to what's being said and you're making your own judgment based on that. You're not taking what somebody said on Twitter and going based on that. So
so there is like a slightly fundamental side to it, and then there's also we sold down to some good, like some levels that if it was any other day and we were trading at those levels, I would take a stab long, and so to me, it was like when you have like a fundamental thing that, at least for me, and I understand if others saw it differently, for me seemed good. And then you tell me we sell to support, that's when I buy calls every time,
Yeah, and it's all going to be digestion still. We could, like I said, we could gap down heavy tomorrow. It really just depends on how this whole meeting was viewed. And like I said, to me at least, it depends on what side of the field you were on going into it. Not as far as, long or short the market, but what you thought, we should be getting out of the Fed. And to me, it's positive to hear that, now they're not looking for unemployment to tick higher over 4%. They're not looking for economic activity to slow down. They're just looking for inflation to continue lower like it has been. And the big thing he pointed out is just to see more data points of that. So I would say three more months of data points, and if everything can hold up well there, then I think it's pretty much assured that we're going to have no landing. Going from a hard landing to a soft landing to no landing. And that was another question they asked Powell today. I forget what he said, but it was another positive note on the overall economy and that they like where we're at right now. But yeah, I do think if we rip extremely higher, we push that 5,000 mark on SPX, then there would be a reason to look for some downside there. If that comes on nothing, because I do think we're still at risk of pricing in too much too soon overall. While we know that the Fed still needs a few data points, we're pricing in a lot before we even get those data points. So, but at the same time, the Fed could know that they're about to start cutting right now and not tell us. I mean, transparency to them doesn't really equal outcome in my eyes. So
that makes perfect sense. I got one more question off topic of the Fed, but on topic of ER reports. They were good. I mean, if you ask me, Google's was good. Microsoft's was good. AMD's was good. They were all good reports. I know that, and I've been talking with a few people about it, extremely common for, this quarter, people to say, just guide lower. And especially after, rip of a lifetime last year, guide lower so that the rest of the year is easier beats. And so we did, we got lower guidance out of most of them, but a lot of them had some nice big beats, And so do you think that this was because I was talking to people yesterday, and I mean, to me, both Google and Microsoft right after the report, in my opinion, was a buy, and Google also a buy in my mind. AMD likely a buy in my mind. But do you think this was just kind of, that lower guidance to make the rest of the year easier? Or do you think that there's obviously more to it than just that? But how much more do you think, are they really expecting a pretty dang dramatic slowdown? Or was this just a, guide that isn't a guide where they have to blow it out to do okay?
No, I think it was just really the names are bringing too much too soon. So, and a lot of these people too, these big funds, they buy or sell after the last report. So, if you got in on previous reports on most of these names, you're up, at least 25%, some of them even over 100%. So to me, it's just, if you don't get those phenomenal results, why not take them off the top, look for a lower entry again. If there was nothing crazy that blew it out of the park, what's the sense in just taking some profit versus holding when you got these good returns already? Because in the January quarter, the majority of companies always not necessarily guide lower, but they don't provide a robust guide, and that's because they don't want to have these high expectations for the rest of the quarters of the year, because then that just makes expectations way too high and easy miss there. Normally they're a little bit light in the January reporting quarter.
Cool. Yeah, that was how I was feeling on them. That was how I was feeling on them.
Hey Tilio, just so I have a question regarding that, because you and I have had the conversation around a potential economic expansion going into Q3, potentially Q4, and even Q1 into next year, especially with an election year. But again, I just some of the rumblings I'm hearing from colleagues in upper management and banking, there is some expectation of some sort of economic slowdown. Do you think that is playing into more of a say here with what some of the guidance we're seeing out of these reports? Now, granted, with what Powell said at the Fed today, it would seem that it's unlikely that we need an economic slowdown. But I'm just kind of curious. Do you think that's really what these companies saying with some kind of slowdown in anticipation is more likelier than not?
I think they're being proactive like they were in 21 and 22. As far as on the company side of things, if they're cautious at all, I think they're just being proactive. As far as people thinking a recession or a slowdown might come, I think we're at the tail end of that, because I think you went from 80% of people thinking that a year and a half, 2 years ago, to less than 10 to 15% people now. But can we still see a slowdown? Absolutely. And I think that would come out of the Fed. I think if the Fed waits too long to cut rates, if things really slow down, I think that's where the recession or the slowdown would come from. Is, let's say that core PCE, I think it just printed at 2.9%. Let's say that in 6 months it's sitting at 2.2%. They still don't cut. We don't have any more job growth. Average hourly earnings are substantially lower. Unemployment is ticking 4%. And the Fed still doesn't cut. I think that's where any slowdown would come from. And that's kind of like what Powell said today too, is right now they're in the phase of really weighing out the pros and cons of being proactive on that potential risk versus the risk of cutting too soon. But like Powell said too, they're not going to wait for their 2% target to be met. They probably want stability, a few reads of that, 2 to 2.4%, I would say, on core PCE. But yeah, as far as the slowdown, I think it would be created from the Fed if it does come. But as of right now, productivity's up. You got a lot of companies spending. They're cutting costs where they need to be. So I think they're handling it probably in the best way they can. And I think that's why we've seen the progress that we have on inflation without any serious hit to the economy. But I'm sure you will see, of course, some sectors. I don't want to say it'll be like the financial crisis that we saw. Not that it was much of a crisis at all, but at the beginning of last year, you might see some sectors that get affected like that. I can't think of any off the top of my head, but I think that just comes down to mismanagement there. But as of right now, I don't see any reason to be worried of, let's say, a recession.
And I mean, people don't want to hear it, but like the economy is strong. It could use a cool down as well. I mean, the economy is very, very strong. And so some cooling would be like not only what the Fed wants, but it would be really great for us. It would definitely be that nail in the coffin on inflation for the Fed, in my opinion.
Wow. That
I
was a
tend to
lot of.
agree, River. It just doesn't jive so much with my business model.
Phase what?
I said I agree with that, River. It
Oh.
doesn't jive so much with my business model. I would much rather be able to keep making money.
Yeah, the booming economy. I know. But see, that's the thing, because like that and like not you, of course, FaZe, but it's a really interesting thing we see in like, in a lot of things in the world today. It's just like people don't realize there's middle ground, they think things are like they think SPY is going to 200 or SPY is going to 600, and they ignore everything in between, and it's the same thing with the economy. Like, we have an extremely strong economy that it can cool down and go to just a good economy, and so I think that's just, that's one of the big things we see it in trading every day. Everybody wants like, dumps or rips or things like that. And they ignore the fact that like there's a lot of noise in between those that is really just, normal markets or normal economies. And I think, what we're seeing right now is like people are spending. Obviously, a ton of people are working as well. And so the economy is remaining strong, In the words of Powell, it is resilient, and it is definitely proven that for us right now. And so I think even just a slight cool down would actually be a pretty welcome reprieve, and it might actually pick up business in other sectors more, cool off in some places, heat up in other places, and help deal with the inflation on the way. But I'm just an old guy, dude. I don't know nothing.
Hey, I'm right there with you, River.
Well, that was definitely a lot of data and details to cover for sure. I hope a lot of you guys were taking notes. I know personally I could even rewatch this lecture and get some notes. I want to try and spend the last couple minutes of the class to just focus on a couple of charts and talk about some specific sectors and names to be paying attention to in some, even more detail, a little bit more scrutiny into the end of this week. Like we talked about, it was mentioned a couple times in this lecture to really pay attention to some of those rate sensitive sectors coming into the end of the week. When you see a move such as this, really, based on any event or any move in the market that's significant, some kind of trend reversal or potential trend reversal, I should say, it's very important to see some kind of follow through. And we've seen plenty of moves over the past really year that didn't have that type of follow through. So, for example, we got those early moves lower following that bottom in March. Following those bank failures, we got two of those moves with no follow through. A third one here, no follow through lower, where it's looking like a significant breakdown with no follow through. For example, here, this move in September of 23, we did get that follow through lower. So that break below the moving averages, break below prior lows, we were able to see some continuation lower. But again, same thing on this most recent uptrend. We've gotten those kind of initial potential moves lower, breaks below the moving averages, but no significant continuation lower. So it's really going to be something to be mindful of into the end of this week, is looking for that potential continuation lower. And like Tilio mentioned, that 4,800, definitely a great line in the sand. I mean, it's right around this previous area of relative highs here, as well as right around those all-time highs back from 21 on the SPX. So important line of sand to be paying attention to here. Tilio couldn't have mentioned it more in this class. So that's really one thing to be mindful of going into the end of the week, is just pay attention to where the market trades relative to this key level. And again, right, it's important to note that these key levels that we talk about, that we have classes about, have serious impact on not only the outlook of investors on the rest of the market, but these breakdowns and levels are very significant. And losing some of these massively important levels can prove to be detrimental to sentiment, or significantly strengthening for those that are looking for price to move higher if we come back down to this 4,800 and are able to hold that level. So in terms of the major market indices, definitely going to want to be paying attention to that 4,800. Like Tilio mentioned and some of the others talked about, you got those rate sensitive names. Some of you may or may not be familiar with what that might be referring to. That's going to be really names that are generally ridden with a little bit more debt. Maybe a little bit less stable companies, maybe companies that are just generally smaller, which all roads lead to Rome in that sense. It's really always going to take you to some kind of small cap or riskier company because, to tie this all together, thinking about rates, right, as the Federal Reserve sets their funds rate to be higher, that makes the cost of debt more expensive. So as companies that generally take on more debt and need debt to continue further, they are going to have more trouble continuing their operations, as in order to operate, it's going to cost them more money to get those loans. So the reason that those rate sensitive sectors are important is because it really shows some of the more riskier names in the market and how investors are positioning themselves in those, right? Because those rate sensitive names are a little bit more vulnerable to things like rates, to things like poor economic conditions, which is very generally represented by IWM, right? The Russell 2K ETF, better known as, maybe the RTY for the futures. So just one thing to be mindful of, definitely want to have your eyes on the IWM going into the end of the week, already getting a pretty significant move in the after hour session higher to bring us back above this bull gap. I mean, that's a couple tickers that I'd be paying attention to. Obviously, the SPX, you should be watching that no matter what the day of the week is. IWM especially, we got those future expectations for rates coming out of the FOMC changed a little bit, right? The market's going to be repricing their expectations. And as a result, you're going to see those moves in these more risky sectors or more rate sensitive sectors. What else do you guys have? What else are you guys going to be watching at the end of the week? River, Phase, 1K, Nando. What do you guys got?
T, best stock ever.
T. All right. Why? What are you looking for there?
It's the only thing in the market green today. Best stock.
Can't argue with you there.
Look at that breakout, dude. Things going back to 20.
Same with CVS, and everybody is on that one. And Tilio did mention that rotation into healthcare, so definitely start dumping more of your money into my play, right?
Yeah, I mean, you got to get the vaccine from CVS if you really want it to be a healthcare play. But I guess the more vaccines you get, maybe the more of a healthcare company it is, right, Nando?
we're at number 6 on the booster shot. The vaccine is already taken care of. We're on the booster shot wave now, so maybe number 7 coming soon. But definitely seeing that rotation happen, and we did catch that at a perfect timing.
Thanks, Nando. What else you guys got? Phase 1K, anything into the end of the week?
KO for me actually. It's River got me on that one, but I'm eyeing that one.
What are you looking for?
The 60 break.
Yeah, yes, sir.
We got a dip buy, right? I kind of was early on this one as well. And I figured with the market dumping, we probably see a dip under 60. But once this is at that level, it's a great opportunity, and based on my experience.
Yeah, it's a big one. I remember that one from the past. I haven't looked at KO in a while. But yeah, I mean, even you
Dude,
can tell
those
pretty obvious.
lower 50s on KO are just a buy, dude. Buffett is so deep at like 53 or something like that. If you ever see dips down there, hammer that thing.
Just like T.
Yeah. Yeah.
Phase, anything you're looking at into the end of the week? I don't even know if your mic still works.
Beer companies, those who sell the oils and stuff.
Sam, dude, yeah. Sam.
No, I don't have anything. I don't have anything in particular that I'm looking at. I think the only thing that really catches my eye is Tesla. Continued sell off, continued momentum to the downside. Looking to see where that knife stops. That's really where only thing I got my eyes on. Again, haven't really been much of a market participant the past couple of weeks. I would just like to reiterate, regardless of what you're looking at and everything that we've talked about today, guys, just keep your eyes on the prize, trade safely, trade cautiously, always build your trade plans out, regardless of whatever you're going to trade.
Thanks, guys. I think that could lead us into some closing comments. We talked about a lot this evening. Tilio got real into the details, and I guarantee everybody could benefit from rewatching this one and taking some more detailed notes. But I want to ask everybody to provide kind of, I guess, everybody that was here speaking with me tonight, or I was speaking with them really. What is the one thing that you think everybody should be paying attention to or thinking about following this lecture? What's the main takeaway in your opinion? Let's start with River.
Probably listen to what the Fed has to say and don't listen to Twitter.
I was hoping you weren't going to say long T or something. I was going to tell you this is a serious question.
And
all right,
long,
Nando.
And long T, obviously.
All right, yeah. Nando, what you got? One lesson from the evening that maybe you'll be carrying with you, or you hope everybody else remembers.
So Tilio did mention the fact that all this data, news, whatever, doesn't really matter if you aren't trading and have your feet in the water. So stay away from the noise, and if you feel you sometimes get a gut feeling when that loss is coming. So if you have a little uncertainty feel, then step away from the market and maybe wait for that data to come out and then maybe trade afterwards. Besides that, not much. Keep following my plays.
Thanks, Nando. 1K.
Nothing really related to that, but just put in the work pre-market. 20, 30 minutes in the morning will save you a lot of stress and guessing every day. So put a little pre-market work in, and you guys will be just fine.
Phase.
I'll just add that, based on everything that Tilio and River have talked about, all of us have talked about with respect to the Fed, think of the market holistically. Remember, yes, we are traders, and yes, we do look at micro moves throughout the day, intraday, as well as throughout the month. But just as we've pointed out today, the Fed governs fiscal policy for the economy, which has real world implications on real world companies that we trade. So just because we see this as tradable stock and opportunities to make money, these are real world companies. And so let's take a look at a deeper dive into the data and see how those real world implications have an impact. Just like we've talked about, rate increases, rate cuts can lead to a significant increase in small caps. It's an opportunity to start saying, hey, what is a good small cap company, or what is a good company to start looking at for potential in the future? So, think of the market not just for its day-to-day movements, but always keep your eyes on the market holistically as an investor to find those true diamonds in the rough for potential greater opportunities.
Thanks, Faze. Closing it out here, everybody. Obviously, this might be your first lecture that you have attended for the first time. Maybe you're not even a member of the Discord. Just wanted to give everybody a shout out and let you guys all know we do these lectures 5 days a week, every single time it's live. We got a different analyst pretty much every single night, live lectures. I can't stress enough. These personally changed the way I thought about financial markets when I was first getting started, and now I'm in a position to provide the lectures. So I can't stress enough how important, you don't have to come to these lectures, but really just focusing on your education, right? Making sure you're learning, always growing, not getting too comfortable in financial markets, trying to learn things that you're uncomfortable with, challenging yourself to learn things that don't really make any sense. I guarantee so many things were said tonight that went completely over your head. I would challenge you all to listen again, try and take some notes, do some research on some terms that you didn't fully understand, because I guarantee I could do the same, and that means anybody else in this lecture could do the same damn thing. So couldn't encourage that more. We're all here to help. So take advantage of the resources you have here at Only Options. We know you won't be here for your whole life, but hopefully the time you are here, we can make it as valuable and as worthwhile as possible. So come to lecture. We're here every week, every day of the week. So I couldn't encourage you guys being here more. We are going to be doing another one of these podcast lectures sometime next month, once a month, unless you guys think that the frequency should increase. That said, getting distracted by Face's camera. He really wants to say bye to you all. But yeah, want to thank you guys all for being here tonight. It's always a pleasure. Every single one of us is definitely, real grateful to be able to spend this time with you week in and week out. And we appreciate you guys making the time for us this evening. As always, we didn't get too many questions, honestly, less questions than I thought we would have got in the chat. So any follow-up questions, you guys know where to find us. Yeah, that's everything. Any last words? Any last face cam Face? All
Very
right.
good, Dustin. Have a good one, buddy. Thank you.
Thanks, everybody, for your time this evening. We appreciate you guys all. And let us know your feedback. Let us know what you thought on the session. Send us DMs. Send us what you'd like us to talk about for the next one. We'll see you guys all in the next one. Have a great rest of your evening. Thanks again, everybody. Adios.